If you've ever wondered how traders control massive positions with relatively small capital, this is exactly how futures trading works. When you buy a stock like Microsoft, its price may go up or down over time, and you can hold that share for as long as the company exists. But in futures trading, you buy something called a contract, and every contract has an expiration date depending on the asset being traded. A futures contract is tied to an underlying asset, such as gold, oil, or stock indices. As the value of that asset changes, the futures contract also changes in value. Futures contracts are designed to give traders leveraged exposure to an asset, meaning traders can control larger positions with a smaller amount of capital. For example, a gold futures contract represents an agreement to buy or sell a certain amount of gold at a specific price in the future. However, most retail traders do not actually take delivery of the physical asset. Instead, they simply trade the contracts themselves and profit or lose based on the contract's price movement. To open a futures position, traders must deposit collateral known as margin. Margin requirements vary depending on the asset, market volatility, and whether the trade is held during the day or overnight. Intraday margin is usually lower, while overnight margin is higher because holding positions outside market hours carries more risk. There are also micro futures contracts, which are smaller versions of standard futures contracts. These require significantly less margin and allow traders to participate with smaller account sizes and lower risk exposure. Futures trading also carries risks. The margin deposited is not the maximum possible loss. If the market moves sharply against a position, losses can exceed the initial margin amount. One of the key concepts in futures trading is the tick size. A tick is the smallest possible price movement a futures contract can make. Different futures markets have different tick sizes and different dollar values assigned to each tick. For example, in S&P 500 futures, the minimum movement is 0.25 points, while in oil futures, the minimum movement is 0.01. Each tick also carries a monetary value. In standard oil futures, a 0.01 move is $10, while in S&P 500 futures, a 0.25 move is $12.50. In the United States, futures trading also has a unique tax structure. Typically, 60% of profits are treated as long-term capital gains, while the remaining 40% are treated as short-term capital gains.